inflation that's on a core basis up 3.4% year over year. Keep in mind some of the best equity performance, at least from the domestic market, has come when CPI is in the 2 to 3% range. So some encouraging signs, and there's certainly some more to watch, and this will remain in focus for the very foreseeable future. Hello and welcome back to another episode of Blue Chip Now. This is episode 25 of the second season. So you have two usual suspects, myself, Daniel Dusina, and Matt Mondoux. Dan Cedar is out today, so we have a special guest appearance from our investment analyst, Vince Parrack. So we're excited to dive into some conversation around inflation. I think that's obviously pertinent given some data that came out last week, as well as some conversations from the Federal Reserve. And we'll spend some time at the very end talking about the CFA program. If you go on Blue Chip's website, you'll probably see a lot of letters after people's names, one of which would be CF and A. I think we have 4 CFA charter holders. So Vince just took level 1 of the CFA program, and I think it's going to be beneficial for anyone listening or watching this on YouTube to hear a little bit more about the CFA program, what it entails, what the CFA designation actually is, and the ins and the outs of the process that it entails. So inflation, it's a good place to start. So inflation was low in May. We got the numbers last week. And when we think about inflation, I think the most widely recognized measure is the Consumer Price Index, CPI. I like to focus on core CPI, which strips out the volatile food and energy segments to get a more accurate read. So in May, the consensus core CPI forecast was to be plus 0.3% month over month, but the reading came in at plus 0.2%. It came pretty close to rounding down to 0.1% up. For those that like precision, core CPI rose 0.163% last month. And the bottom line here is that this is a pretty encouraging picture of major CPI indexes when you look at the year over year change. And so what I'm going to show on the screen is just a very simple snapshot over the last 3 years of US CPI in white, so that's the full CPI, has everything in it. And then in blue, you can see core CPI, which is CPI stripping out food and energy because they're volatile. These are year over year readings. So you can see core CPI in blue in May resting at plus 3.4%. So you've seen a steady downtrend here, which is probably the most important thing because we had seen some choppiness to start this year. The May reading was the first month over month change below 0.2% since June 2023. So again, that's an encouraging sign, especially after you had 3 consecutive, call it above estimate inflation readings to start the year. The last 2 readings have been much more of what the market was expecting to begin the year. And that's a shape of continued moderation on the path of inflation towards the Fed's target of 2%, which of course is going to result in a lot of banter around what's the Fed going to do with interest rates. I have some specific takeaways from this report in specific segments, unless there's anything you guys want to add on the headline.
I think it's the devil's in the details here, right? I mean, the headline's interesting. It's good to see the trend in CPI coming lower, but I think the devil's in the details. So getting into some of the nitty gritty here and the specific components that are driving inflation and what, could potentially help ease that, I think would be interesting to dive into.
Yeah. So some of the specific takeaways that I had, and I'll call them out, it's 4 things. Goods, broadly speaking, and within that, used cars. And then on the services side, car insurance and shelter. So I'm going to talk a little bit about each of those. One thing that I don't think a lot of individuals realize is that we have been in outright goods deflation pretty much since the beginning of this year. So when you look at the Consumer Price Index, the most common reading on inflation, it's bucketed into 2 different categories, goods and services. So what I'm showing on the screen right now, in white, you see the goods component of core CPI, and in blue, you see the services component of CPI. For those of you that are just listening on Spotify or whatever platform you use, you can see the visuals if you hop onto our YouTube channel. So anyways, what I'm showing is just that services continue to be the reason that inflation is up, essentially. And so goods being in negative territory, specifically having fallen 1.7% over the past year, you've had a lot of moderation there. And keep in mind, these figures are excluding food and energy. So it's things like apparel, right? Or shopping. Like all of these things, clearly people are spending less money on because either they don't have an ability or willingness, but that's going to cause these producers to pull prices back.
And I think we had a pull forward in demand, as people couldn't travel, right? This was a well-documented phenomenon. You couldn't travel. People still wanted to spend. They would go to Home Depot. They would go to Best Buy. They were spending on goods. How often can you buy a TV? How often you're going to renovate a bathroom? So the demand, I think rightly so, has waned.
Yeah. And, kind of speaking of the pandemic, one of the hottest categories from an inflation perspective in and directly after the pandemic was used cars. Used cars were at astronomical levels from a price increase perspective. And what you see now, again, same type of chart showing year over year price increases. The white line is still the goods component, of course, CPI. The blue line is now used cars and trucks, price increases year over year. So if you look way back in 2021, you had used cars, the prices that increased, 45+%. Obviously not sustainable, but you've gotten back to a level now where really used car prices have been decreasing since the end of 2022 to the point where now they rest at, more than -9% year over year. I don't think that this is an area where you're going to see a ton more disinflation, just given how much we've already seen. But the fact that used cars actually did tick up a little bit in May, if you looked at the month-over-month numbers, which I'm not showing on the screen right now, that kind of implies to me that we might have found a bottom there. And if you are going to get continued suppression of these inflation readings, we've said it before, it needs to come from the services side realistically. So when you look at some of the components on the services side, first thing I'll call out is car insurance. So even though you might have used car prices that have, call it, bottomed out, I still think they're an important category to watch because of some of the downstream effects that they can have, especially on things like repairs and especially like insurance. I think one of the surprises we got in last week's report was finally getting a bit of a downtick in car insurance premiums. And this comes after a pretty ridiculous run of monthly, insurance premiums are up 20% year over year for cars and trucks. That's pretty crazy. And I feel like that's not something that gets called out when people talk about inflation. When people think about inflation, it's just, going to the grocery store or buying a new TV, right? The tangible goods. I don't think a lot of people recognize something like car insurance, that even though it's only, I think, 4% or so of the consumer price index, that's a price that people feel on a monthly basis. And to have it up 20% year over year, that's pretty astonishing. So I talked about falling car prices. I think that should be a leading indicator, if you will, of insurance costs coming down. TBD, but there's been some funkiness in terms of other states having weird regulatory changes and all that. But either way, seeing a little bit of relief there, I think is welcomed and an encouraging sign. And the last thing I'll say in terms of specific takeaways is that if you've listened to any of our media in the past, whether it's my quarterly outlooks or some of the webinars we've done, or even some blog posts that we've written, you will know that shelter is the largest component of the consumer price index. So that includes both rent that people are paying for primary residence and owner's equivalent rent, which is what a homeowner would pay in rent if they were to sell their house and go rent as a primary residence. So I'm showing rent, full shelter year over year in the orange line, and you can see it's still elevated at plus 5.4% year over year. But the encouraging thing is that the measures within shelter, like I mentioned, rent, owner's equivalent rent, they are easing just at a frustratingly slow pace. This was not necessarily the component that was primarily responsible for the downward surprise this month, which to me actually is another encouraging element, just because if you're getting good readings without some of the rent statistics being really supportive, then to me, the fact that you still have some downward pressure on shelter still to come indicates just further downward trajectory on inflation. So at least that's just one way to take it. Basically just telling me that there's more disinflation in the pipeline as we work through this year. And so, overall, it remains to be seen exactly how the Fed interprets this, because Vince, you and I were talking about this yesterday, how it was interesting. CPI came out on a Wednesday, the Fed was meeting, right? And, they released a summary of economic projections. Kind of tough to tell, because did they adjust their expectations based on this report or not? I don't really know.
Right, yeah, it was pretty interesting because they did a dot plot back in March, and the median estimate for cuts was 3. And just recently at the June meeting, their median estimate was only 1 cut. And during the press conference, when they were asked if they took into consideration the CPI values that came out that morning, they said that they were able to adjust, but he didn't mention if anyone actually did.
Right, yeah. Ultimate caution, right? Yeah. When you say dot plot, can you just explain what exactly that is and why it's important?
Yeah, absolutely. So there's 19 members in the FOMC and only 12 are voting members, but all 19 put an estimate on the dot plot for when or how many cuts they expect at a certain point in time. So the one we're looking at is at the end of 2024, how many cuts does each person expect? So they put their dot on there for 1, 2, 3, however many, and then the number that people talk about is the median typically.
Got it.
So,
and cuts is related to basically they're voting on how many 25 basis points or 0.25% rate cuts do they expect to the federal funds rate.
Yep.
Yeah. So, like I said, overall, this is a positive sign in my eyes. I mean, the market obviously liked it because, the market's operating under the assumption of, lower than expected inflation print equals more supportive Federal Reserve, less interest rate pressure equals stocks go up, essentially.
Well, I think this also highlights, the stubbornness of the shelter component. I mean, it really highlights and what in all likelihood is going to be a multi-year investment within the housing sector in the U.S. economy, right? I mean, we clearly have a supply issue here, supply-demand imbalance. People aren't moving. They feel locked into their low rates. How could I sell my house? I'm going to have to pay as much or more to downsize. I think that's what I hear a lot of people say. And until we can build enough supply to ease this imbalance, it's tough to see what's going to get housing back to what we call normal levels. And when I say housing, I'm talking about houses available for sale. So even though inventory's up 30-some% this year, it's still below historical averages, kind of the pre-COVID levels. Yeah. And it's ironic, the Fed thought they could slow the housing market down by increasing interest rates. This is their main tool to affect the economy. But in reality, it's almost had this unintended consequence where now current homeowners feel trapped. They don't want to sell. So supply is greatly depressed.
Yeah. And it's like, anyone that is looking to buy a home is kind of snookered, because it's like the natural assumption is I wait for better prices, right? I'm going to wait till interest rates come down so my total monthly cost is lower. Well, what's going to happen when you do get a tick down in 30-year fixed rate mortgages? Mm-hmm. You're going to get a flood of buyers coming into the market, right? So I'm kind of with you where I'm not convinced that this is going to be a quick solution. We've talked about in the past how home builders are not incentivized to build what I would call affordable homes for those people that are looking for homes right now.
Right, starter homes.
Starter homes, right? Home builders can't make a well enough profit on those starter homes, call it in the $200,000 and $350,000 range. They mostly build that, 2,500 square foot, $500,000 house, because that's where they can essentially make it worth their while.
Yeah, maximize margins.
Yeah. There's a lot of funkiness that happens in the reporting of the shelter component of the consumer price indices, but it's also like a ridiculously high portion of CPI, and that's not a explicit cost that individuals bear every month. So there's a lot of weirdness that happens, and that's kind of why we like to look at multiple measures of inflation, whether it's the CPI indexes or personal consumption expenditures, which is the Federal Reserve's favored measure of inflation. But you got to parse it together with everything else that comes out, like retail sales this morning that came out super soft for the second straight month. So all in, what this points to me is just that the trajectory is intact. There's been some moderation in some of the really high flying categories in terms of price increases. And, at the end of the day, we have inflation that's on a core basis up 3.4% year over year. Keep in mind, some of the best equity performance, at least from the domestic market, has come when CPI is in the 2 to 3% range. So some encouraging signs, and there's certainly some more to watch, and this will remain in focus for the very foreseeable future. Anything else there before we jump over to talk about the CFA program?
No, let's get back into it and give us some PTSD and Vince the mic to talk about what he just accomplished and where he's at.
Yeah, so I think it's well worded, Matt. The PTSD is real. The CFA program is known to be rigorous. I'm not going to front run Vince too much, but I introduced Vince Parrack. He's an investment analyst here at Blue Chip Partners. He just recently sat for level 1 of the CFA program. So with that in mind, Vince, can you just talk a little bit about what the CFA program is and what it entails?
Absolutely. Yeah. So the CFA program, I believe we already mentioned, Chartered Financial Analyst. It's a prestigious certification for finance and investment professionals who aim to deepen their knowledge and expertise on portfolio management, investment analysis, and ethical standards. There's quite a bit behind it. There's several topics on the exam. A few examples are economics, equities, fixed income, and several more. And it takes quite a bit of time to study for. The PTSD is quite real.
So how many questions are on the exam?
On the exam, there are 180 questions.
180. And how long is the exam?
So it's two 2-hour and 15-minute sections with a half-hour break.
Well, we forgot to say that these, at least for level 1, it's multiple choice questions, right? And there's only 3 answers.
3 answers.
How hard could it be, right? You know?
So the
what's the current pass rate for level 1?
So the current pass rate for the last 10 years is 40% on average. Okay. And they estimate the typical passing score is in the high 60s. So only 40% of people are getting above high 60%.
I remember like when I would take took the exam, and I would get like an answer that wasn't one of the 3. So I did my calculation. I'm like, yes, I know that I didn't do that right. Yeah. Because so often they have like the most common, the most common mistake. So I would be so happy and relieved when I got a solution that was not on one of the answers. I'm like, okay, scrap that. Let me try something else. And eventually get an answer and, feel like maybe that's right or wrong.
It's a rigorous test. How much time what's the guidance in terms of how much time to study, right? How long to spend studying, when to start studying, all that?
So the general guideline is 300 hours of study time. So however you can fit that in, working a full-time job, it's, about 4 to 6 months. You're still doing a lot of studying after hours, a lot of weekends, but I think it's a pretty realistic time frame, and it's a good amount of time to keep everything fresh in your mind. So yeah, roughly 6 months, 4 to 6 months, and 300 hours.
So you just took level 1. How many levels are there, and what are the differences, I guess, between the 3? Is it subject matter differences or like test format differences?
Yeah, so level 1 is just multiple choice. That's the basic format of it, and it's very wide, but not as deep into the subjects. Level 2 and 3, it goes a bit deeper into more specific subjects. Level 2, there's case study question formats. So you have roughly 8 questions per case study. And then level 3, you get into essay response and multiple choice.
Just daydreaming about pension accounting and IFRS versus GAAP accounting standards from level 2. That was some of the most fun I've ever had in my entire life, So like when you look at, I guess, how you prepared for level 1, did you spend more time on certain subjects than others? Did you feel like certain subjects were more or less harder to understand than others, or?
Yeah, I mean, for me personally, just with the background I do have in having the Series 7 and 65 and finance degree, I had certain subjects where I felt more comfortable and familiar, and I felt I had a good background knowledge on that. So I definitely spent a little less time on those and went a bit deeper into subjects like alternative investments and derivatives, which I did not learn too much about or quite as much about those in my previous studies.
And what would you say from your learning from studying for level one, like what are some of the things you kind of use now in your like day to day? Was there anything that helped really prepare you, even just getting to sit for the first level out of 3?
I'm in my day to day, it makes it a lot easier to recall what certain indicators are or how the market will react to certain indicators. I've also learned certain skills of financial modeling. I actually have to do a practical skill module after my exam, and it helps you learn how to apply what you learned in your daily work life. So I believe that's going to be very beneficial. I plan to start using that going forward.
Yeah, and I don't know if you feel differently, Matt, but to me, like, yes, there was a lot of subject matter through the 3 levels of the CFA program that was directly relevant to what I do. There's a healthy amount that isn't, but to me, the biggest benefit of a test like the CFA program is that like you can't get through all 3 levels successfully if your work ethic is not dialed in. You know, you said it best. You're working a full-time job and you have to somehow fit 300 hours at a minimum. For me, it was always more than that, into basically a second job, right? Yep. And so like, to me, that ingrains what I would view as just a world-class work ethic, you know, that you kind of carry on to everything else. Because those tests are hard, but at the end of the day, it's also a mental battle because these tests are rigorous, but they're also not offered very frequently. Like when Matt and I took them, I think the same for you, but level 1 was offered twice a year and levels 2 and 3 were only offered once a year.
Yeah, the stakes were high.
So it's like high stakes. The work ethic has to be there. And that to me is like the biggest translation to just about any job in the financial services world. But for us, the way we operate at Blue Chip, I think the CFA translates really well, just given the level of, I would say, detailed analysis that takes place within our investment committee.
And so, Vince, when did you take the test?
So I took the test on May 20th.
May 20th. So, and then so that's another thing for the listeners or people watching on YouTube out there. When do you find out if you pass?
I should be finding out sometime in 1 to 2 weeks from now.
Right. So you also have to kind of deal with the anxiousness of the delayed results, which is frustrating. So and then one final question for me. So for listeners, people listening, watching out there, maybe they're the ones thinking about this, or they have family members that should consider this program. What do you consider as the benefit? Who is this test for? And who should really strongly consider taking the CFA?
Yeah, I mean, I'd say if you're thinking about it, definitely go for it. It'll elevate yourself. It gives you a leg up, and it really enhances your expertise and your knowledge on the investment industry. So if you are focused on going after some sort of investment analytic job or portfolio management, I think it would be very beneficial to, at the very least, give it a try. And it's going to take a lot of hard work, and you got to be diligent, but it will definitely pay off. It's a very prestige certification, and yeah.
And I would also add, I think the return on investment's great, right? I mean, you can go the MBA route, so you can get a master's in business, or you can get the CFA. The CFA is a tremendous amount of time. The people who make it through the program, I think it's not a guarantee, right? Like each level, I think the pass rate's somewhere around 40% or below. But when you look at the cost, all-in cost, it can be a lot less expensive than an MBA. And if you're really geared towards finance, I think the return can be great. And that would be what I would stress to anybody prospective taker, test taker, anybody interested in finance. I mean, it's a great thing to put on your resume. And the knowledge you gain from it is really outstanding, and it can really set you up, great career-wise.
Yeah, couldn't agree more. Well said, Matt. Anything else before we call it a wrap today, guys? Okay. Well, thanks everyone who's listening or watching on YouTube for tuning in to another episode of Blue Chip Now. If you are just listening, or if you're watching on YouTube, share with your friends, colleagues who might be interested in hearing about inflation. And if you're just listening, tune into the YouTube channel so you can see our smiling faces. Thanks again for joining. We'll see you next week.